Hi traders, today I'm going to talk you through the risk and reward calculators. First of all, what is risk and reward, and then we're going to go through just a couple of scenarios of why the risk and reward is very, very important when it comes to trading for the long term. So what is a risk reward calculator? Well, a risk reward ratio calculator is just a calculator that is used to check if your trade's risk is adequate towards the reward. You may have heard different sayings in the past, like 1-to-1 risk reward ratio, 2-to-1 risk reward, or even 3-to-1 risk reward. And that is basically just showing us that for one risk, whatever that risk is, you can gain 2 to 3 in reward. How much you win when you're right and how much you lose when you're wrong is definitely essential for success in the markets, depending on your trading style. Okay, so this may not suit your trading style, and that's something that you have to consider as well when you are trading your specific strategy. Now, just an example of what risk reward is, I've just got a little diagram here. Over here, what we have is a price chart, and on the price chart we can see that the market was in a bullish trend that flipped, and you took an entry into the market. Okay, so your entry was below that swing low there, and what you need to work out is your stop loss. Okay, so your element of risk. Okay, now risk is always going to be very, very important in trading, in terms of how much you risk and where you risk in the market and where you place that risk. So let's say your risk typically is $100. Okay, so let's just say your risk is $100. You can also give this pip values as well. Let's say, for argument's sake, just to keep the math easy for us, it's 10 pips. Okay, so you've got $100 of risk. So a 1-to-1 risk reward, okay, so take profit 1 would be $100, okay, or 10 pips. Okay, so what you can do is have a similar reward to your risk, or the same, and that basically would be classed as a 1-to-1 on your what they call R and R, which is risk and reward, or reward to risk ratio. Okay, doesn't matter which way you put it around, really. Now, obviously, you can see here, if you were to obviously lose that trade, okay, you would lose $100. So on an aggregate scale, you want to be right, obviously, more than you're wrong. But if you are doing this long term, then, and you have a strategy that's maybe not winning all the time, then a higher reward to risk ratio is going to be more beneficial to you. So especially if you look for a 2R, okay, so this would be $200 or 20 pips, and that is what we would class as a 1-to-2 risk to reward ratio. Okay, again, you can swap those around and have reward to risk. So that is a basic understanding of risk and reward. Now, you want to be in a position where you know the best risk reward ratio for your strategy. Now, you can do that in back testing, and what I would suggest that if you are back testing, don't just back test 1-to-1s, 2-to-1s, 3-to-1s, things like that. You need to back test sort of support and resistance mainly. Okay, and then I want you to identify what the average, okay, the average R and R is. Okay, and that's what you're going to be looking to target on every trade. The reason I say that is because it'll help you in the long run. Okay, if you're just targeting 1-to-1, 2-to-1s, you may get stopped out on a few more trades than you should. So always use it in sort of confluence with other sort of systems here. You know, maybe targeting that low there is a 1.2 to 1 R, so risk to reward there. So let's have a little look at a couple of different scenarios in terms of trader A, trader B. Okay, so let's say we have trader A takes 10 trades, okay, and only wins 5 of those trades, okay. Let's say trader B does the same, takes 10 trades, wins 5 of those trades, and you can already tell, you know, we're going to put an equity curve here, but you know the outcome is going to be better for your 1 to 2 trader, okay, because what would happen, let's say we have it in a scenario where we have 5 winners, 5 losers, okay, so everything's looking good for trader 1. You go up and you start making decent gains in your account, 1, 2, 3, 4, 5, but all of a sudden you come into a drawdown period and you lose 5 trades in a row, okay. This is what your equity curve would look like if you were trading that style, okay. Let's say trader B, same, we have 5 in a row, okay, so we expand this up, 2, 3, 4, and 5, okay, and then you have 5 losers, but the losers are only going to be half the move, okay, so you still have opportunities there to be up on your equity curve, okay. Now obviously that's not how trading works. Obviously you could have different scenarios where you have sort of 1 winner, 2 losers, 1 winner, but essentially if you're trading at a 1-to-1 risk reward with a profit factor or a probability of your strategy being 50%, then you're basically just going to be a break-even trader. That's not what you want to achieve. If you are looking at this more from a long-term perspective and you want to be trying to gain that 1 to 2 reward, it gives you more room for error, essentially. That's what you're looking to do with having a higher risk reward, having more room for error, okay. So that's what I would say is good about risk reward calculations, making sure that your risk to reward is just higher than 1-to-1. Obviously that's not always the case. There are strategies out there that are 1-to-1 and are very good because the profit or the probability of the strategy is higher. So let's say you've got a 60% plus probability on a strategy, then 1-to-1 would be absolutely perfect. But if you were to just 50% of the time you are right, you need a higher risk reward ratio, okay. So take into consideration risk reward calculations within your trading. You can find multiple risk reward calculators online, but that is the basics of risk reward. Hopefully you enjoyed the video. If you did, leave it a thumbs up, subscribe if you're new.